Today, so is the property price rise over or not? Hello again, it's Martin North from Digital Finance Analytics, one of those posts covering finance and property news with a distinctively Australian flavour. Today, I'm joined by George McCluskey. Hi, George.
Hi, Martin. How are you? Great to see you.
Yeah, good to have you back on the show again. And look, I want to ask you some important questions today. The ABS came out yesterday and said property prices have boomed more than 20% over the last year, right? And a lot of the banks are saying, oh, prices are going to fall. It's going to be all gloom and doom. Now, the question is, where are we in the property cycle? What's going to happen? And is property still worth considering?
Good question. There's a lot of good questions there. We're going to have to unpack those. But look, the fact of it is we are in uncharted territories at the moment. Things have changed. I mean, we had COVID, which affected property a lot different to what people expected. And now suddenly we have got the Russian-Ukraine conflict going on, which is going to be a bit of a game changer as well. So there's a lot going on, a lot to unpack in regards to that. So where we're going to start, our property price going to go up or down? I think we should end with that because I think we need to know the fundamentals of what we're looking at before we get to that stage.
Yeah, so I mean, there are some fundamental drivers. One of the things we do know is that one of the main reasons why property prices went so high was because of the free availability of credit, the low interest rates, the fact the banks were lending like there was no tomorrow. And if you look at the average size of the loan that people got, last week compared with 2 years ago, it was up at least 20%. We know that the mortgage rates were down at 1.99% at the bottom of the cycle, as it were, which meant that people could afford to borrow a lot more, and that pushed significant prices up. Also, there's a lot of migration. So a lot of people were looking from, say Sydney and Melbourne, looking at Queensland, for example, and looking at houses because they could work from home rather than actually have to travel to work. So there was a lot of, cross currents there, and yet international migration was zero. So that factor disappeared. So it's interesting watching all of those dynamics, plus, of course, all the government stimulus, the first home grants and the home buyer stimulus and all those things, and the state stuff and the lower stamp duty. Everyone was throwing money at the system to try and keep it up. So there was a lot of stimulus, plus COVID, of course, all the COVID payments. So wherever you look, there was wall-to-wall stimulus, wasn't there?
There was. And also, I mean, when you think about how much money got put into the typical Australian's bank account from all the extra money that the government was spending, this is unprecedented. We've never had the amount of savings. I mean, if you look at the amount of net savings the average Australian's got, we've never had this much in history, ever. And we actually became the richest country in the world over COVID, which is fascinating.
Yeah, okay, so property prices went up, so that helped. And of course, the interesting thing about that savings, and I agree, there's a total amount which is very big, but it's not equally distributed, right? What's fascinating is that it's drifted very much to those that are actually more affluent. That's where a lot of the money lives. There's a whole lot of other people who are living pretty much hand to mouth with no savings. And in fact, the data from the ABS suggests something like 25 to 30% of households have less than 1 month's savings available. So we've got a very unequal society and unequal distribution at the moment.
Unfortunately, that's what's been happening. And look, Australia generally is quite good when it's distribution. And what happened with the pandemic is, the rich got richer and the poor got poorer. And this is a big sign of inflation. That's what happens when you have inflation, because we've had a very low inflationary period where it started balancing everyone out. During COVID, our inflation went through the roof, and inflation is what created inequality. Inflation is what has made the rich richer. Inflation is what's pushed property prices up, because inflation pushes hard assets up, soft assets down in the long term.
Yeah, and I suppose the other way to think about it is if you've got, a certain size of money supply, right, and a certain pool of assets, and then you double the money supply, it may not surprise you that prices go up. But in fact, what you're really doing is you're devaluing the dollar that actually you had, because basically you've got twice as many dollars chasing the same assets.
Exactly. And you've got to look at prices of property, stocks, bonds in relation to the price of money, because there's a relationship there. And basically, when you've got more money, you've got more supply of money, therefore that's going to create more demand for other stuff. And it all comes down to supply and demand when it comes to property or anything really economically. And that's what's really going to give us the right answer to our property price going to go up or going down. And actually, the answer is going to be surprising for a lot. I mean, most people expect me to say they're going to go up. That's what they normally expect me to say. And they are in certain circumstances, but there's a few property markets in Australia that I predict are going to go down.
Well, let's just talk about that in a second more. But just before we do that, I've got this view that there is a sort of a fake wealth effect going on, right? Because, you might feel as though you're more wealthy because the dollar value of your property has gone up. But one, it's only accessible if you sell it. And two, it may not actually in real terms be that way because, in fact, you've just got more dollars sloshing around the system, but you have to pay more dollars for everything. That's what inflation does. So I think we need to be careful about real wealth and fake wealth in this context too.
Yeah, if you look at the GDP of Australia and the actual trade balance, I'll suggest what we've got is real wealth because our trade balance has gone up and we've got more money coming in, less money going out, which indicates that. So when the trade balance is negative and everyone in the country money goes up, that's fake wealth. When the trade balance and we've got a massive surplus, the big surplus, that actually means we are actually wealthier. But unfortunately, the people that had property, the people that had assets are the ones wealthy. And unfortunately, there are some people that are getting left behind, which is a bit of a problem. And I think there's something we need to do something about.
Absolutely. Well, this whole idea of Australia as a relatively balanced and egalitarian society is falling apart, right? We're sort of mirroring more and more the US extremes, and South America is another example. So it is important to understand what's going on and, ask the question, is this the sort of society we want? Because unfortunately what happens is we have a lot of people falling off the back of the lorry, right? Which they can never get into the property market. They live from hand to mouth. They end up with multiple part-time jobs that don't really pay very well. And then on the other hand, you've got some people who actually have multiple properties, multiple investment properties, done really well, and they're sitting on significant assets and significant wealth. And somewhere you've got to say, how far can you stretch this sort of elastic, right, and still maintain the very characteristics that made Australia Australia?
I totally agree. And I love the way we've got an egalitarian society, and I think we need to try to maintain that. And you look at America, and I haven't been there for a while because of COVID, but in America, some streets you just don't want to walk down because it's dangerous. And Australia is not like that. Australia is a safe place. It's a place where the Aussie mate will give each other a hand. I love that about Australia. And you look at during the floods, quite a few years back, not these ones that came recently. What happened when we had the floods? Everyone was chipping in, putting money in, helping everyone else. And then we had the Katrina thing happening in America, and there was looting and raping and pillaging and stuff like that. And it was a very different vibe.
No, that's spot on. Yeah, so there is more of a community spirit, I think, here, although I have to say that I've been here, 25, 30 years now. And over that time, I think we have actually lost something which was very distinctive about the spirit of Australia. And I hope we don't go further down that direction because, it is actually the community and the ability of the community to look after each other, I think, which is a really important characteristic. But anyway, let's come back to this point. You were just making the point that not all property markets are going to behave in the same way, right? Some might go up, some might go down. Let's pull that apart a bit more and let's try and understand which markets are going to do what and why.
The fundamental thing in regards to your question is that the one thing that affects price more than anything else, it all comes down to supply and demand. If there's more supply, less demand, property prices go down. More demand, less supply, they go up. And this goes on for everything, really. And if you ever heard of Freakonomics, they actually go through the numbers and show you this happens in human interactions and everything. But for example, Apple created the iPhone. And if they've got demand, for example, 10 million iPhones, they don't actually create 10 million, they will build 9 million. And then what happens is they know they've got an undersupply, people line up to get their iPhone and it all goes crazy and it creates a lot of demand. And so they artificially do that. But with property, there's usually a lack of property anyway, but it depends on the market. So in property, that's what happens. So looking at demand supply, then what we're going to do is look at property cycles. And property cycles, when we look at property cycles, we're looking at the property clock. I'll quickly explain the property clock for those who don't already know how it works. So 12 o'clock's the peak, 6 is the bottom, and then when you hit 6 o'clock, you hit the bottom of the cycle, and then you slowly go through the recovery phase. Once you hit 12, you hit the peak, and then property prices start going down. Now, there's 15,000 suburbs around Australia, so there's 15,000 property clocks, but if we generalise them and look at the cities, it gives you a bit of an indication, because normally in a city, the whole city moves as all those individual clocks, but in the general direction. So Melbourne, Sydney, and maybe even Canberra are probably 11, 12 o'clock at the moment, because they've already gone through quite a bit of growth and they're hitting at that peak from where they normally are in relation to the other property markets. So if you look at Brisbane, Adelaide, Perth, they're severely undervalued compared to where they traditionally stand compared to the other properties. So what I like to do is look at, okay, where are all the properties, where they're based, which ones are undervalued for a while, and if you look at that, there's potential to grow. It's a bit like if you were going to buy apples and oranges, and then every week you went to the grocer and oranges just kept going up and up and up, and suddenly they both started at $1 a kilo. If oranges go to $20 a kilo, well, that's going to push apples up, because people are going to say, stuff it, we'll have some apples and save some money, until it gets a bit of a closer sort of price disparity. And that's basically the way it works. And it's funny because when you've got one market that's lower than the other, it does actually make a big difference to pushing it up. So property prices going up in Sydney affects property prices in Adelaide.
Now, it's interesting, and quite often what I see is when prices are actually out of kilter, you'll see people looking at other markets. So that's one of the reasons why South Australia and Tasmania have been quite strong, because there's been a lot of interstate transactions, because people could get better value than in Sydney. And one of the reasons why Queensland has been so strong, again, is because the momentum there was very different, very, as you say, a different part of the cycle. So you got a sense there that sort of Sydney and maybe Melbourne are close to the top, and maybe Canberra. What about the smaller markets, though, like Tasmania and South Australia? It was interesting that the ABS data showed there was still significant growth there, as is Brisbane. So are those ones where you still think the clock is the other side of the dial, as it were?
No, because they've still got more room to grow. Because when you've got $20 oranges and $5 apples, even though they've gone up to $5, they're still cheap compared to oranges. And that's what's really, it's about comparing the markets instead of comparing the meerkats. I had to get that joke out, sorry. Anyway, so basically I would say that Melbourne and Sydney, I wouldn't be surprised if by June they don't start dropping a little bit.
Well, we've actually seen some of the latest data suggesting that some sectors of the market are already sliding. Even the CoreLogic numbers were down over last week. And again, we have to emphasise that properties in different types and different tiers will perhaps behave a bit differently. Not everyone's going to move at the same pace in any particular direction. But there are some mega trends that are worth thinking about, and certainly. We also know that the apartment sector is still looking much sicker than the house sector, right? So a lot of the momentum over the last year or so has been in the house sector, standalone properties with land, rather than in the apartment, particularly the high rise. So what about your property clocks for the high rise sector? How different are they from houses?
Yeah, look, the high rise sector is a unique sort of beast. It's very different to houses, and that's because with property, if you get a house or a townhouse, you've got a land component. When you get a land component, that creates a bit of scarcity. However, with high rises, the scarcity is not there, because, for example, I think who was that guy, the big guy in Sydney who was planning on doing this massive high rise, Lowry. He can knock down a couple of houses again. He's already bought all the land that he needs and just build another high rise, 30 stories high, and then suddenly, bang, there's all this oversupply. So what happens is in the CBD, but also Gold Coast, a place like that where there's a lot of high rises, there's always an oversupply and a big correction. So me personally, I don't like investing in high rises because they're too volatile. And one, you've got to really watch the overcorrection because there's always no supply because they can build some more. But if you go to a suburb with a council that doesn't allow high rises, well, it's harder to have an oversupply even though the market's hot because there's only a certain amount of townhouses and houses you can build. So by having a limit to what you can do in a place does give it more intrinsic value. So I've just never been a big fan of high rises. I think that when the property market gets really hot, once all these immigrants are back, there's going to be a bounce back because they've done very poorly. And if you look at historically, the difference between high-rise apartment and a house, it's usually the difference is a lot closer. And at the moment, they're quite far off. And when there's a big gap, it's going to fill. But for my long-term investing, I don't care about that. What I care about is the long-term scarcity of the property that's got a bit of a land component.
And one other question which springs to mind is we've got interest rates ultra low at the moment. The expectation is that interest rates will rise. So do you think that's going to have a major impact on the property clock and where it goes from here? Or do you think that rates are still so low in absolute sense that it really doesn't make a lot of difference?
Look, the low rates did create a bit of a frenzy, and they're expecting rates to rise. And there's some people expecting them to raise quite sharply until June 2023. 9 basis points, and other people are saying less. Now, the RBA said they're going to be raising interest rates once we hit 3% wage growth, and we're at 2.3 at the moment. So we're a bit of a distance away from that. Now we've got this conflict in Ukraine and Russia. So what's happening is petrol's gone up. I mean, it went up to $3 a litre in Adelaide about 6 days ago.
Wow.
But it's dropped back down again.
Yeah.
And so it's hit pretty hard. The government now, the national government is trying to think about cutting fuel excise to make it more affordable. So what's going to happen now is the affordability of living is going to go down. One, it already has gone down because we've had inflation that no one really talked about through COVID, through the printing of money. But now we're going to have more inflation because fuel affects everything. So with fuel, even the steak that you buy from the supermarket is affected by fuel prices, and meat's already gone up in price in supermarkets because of the fuel going up.
That's right, and it's that significant outflow from the fuel supporting the costs and price rises and so many other factors, and then it flows on through. My own perspective is that the wages growth that the RBA is hoping for is still, I think, a bit illusory. I think it's going to take a long time to work through, if it does work through. And I actually think that the rise in interest rates, so to give you an idea, right, if you had a 1.99% mortgage, right, and it went up to 3%, your actual physical repayment goes up by 15%.
Yep.
Right, simply because, of course, it's mostly interest. If it goes from 1.99% to 4%, your actual physical repayment goes up by 30%. Right? So we're quite leveraged, and it goes back to what we were saying earlier on. There are some people who are extremely close to the wind already with these ultra low interest rates, so they potentially might find it very difficult if rates went up. But there are other people who are doing quite well who will be able to find the extra money no problem at all. But to my mind, that's another factor to sort of put into the mix, right? In terms of how far and how fast prices might move. I have a view that interest rates probably won't be as high as what the markets are saying, which is up by 2% over the next year. And it's not going to be what the RBA is saying, which is nothing for the next year. It's somewhere between the two, right? So, but
I agree. I think there will be an interest rate rise. The thing is, vacancy rate the lowest we've ever had in 16 years in Australia, which means there's a massive lack of property. So I still think the fundamental challenge is there's a lack of property. At the moment, because of the Russian-Ukraine conflict, there's less property in the market, so people are a bit scared. So people are a bit hesitant to buy or sell property at the moment, and that's what happened at the beginning of COVID. So the market has dropped, and I think that's going to keep a little bit cool for a while, because when people are in times of uncertainty, they're not going to either buy or sell, which is going to create more of a shortage. So I really think, if you know how to pick the right properties, in Brisbane, Adelaide, Perth, that you're going to do very well. I really think you can do well. And you're right, interest rates going up may affect property, and it could have a correction. And we've had a 25% growth and maybe 17% in real terms when you take away inflation, which is still pretty big. But on the world scale, there's a lot of countries that grew a lot harder than us. I mean, we, Turkey, New Zealand, Czech Republic, Slovakia have gone nuts. And I think New Zealand are in for a big surprise now because I can't believe how expensive New Zealand is. Auckland, I mean, 1.5 million median price range. That's just crazy. That's unattainable.
Yeah, the New Zealand central bank there is actually now forecasting a down movement in prices. So they had a very significant rise up and a significant rise now forecast down. So it shows you how volatile it can be. And, some of these things can happen quite quickly, right? Because there's always this sort of lead lag effect. So, prices change, demand changes. I guess the other question, just before we close off, is the listings numbers. What's quite interesting about the listings for houses still seem to be going up, which is unusual at this time of year as well. So I wonder whether there are actually going to be more supply of properties for sale coming onto those markets where there are essentially, more choice. What do you think?
Well, we had so much lack of listing over the last 2 years that surely these people that didn't sell in the last 2 years that wanted to are finally going to start coming back. So I think with what's happened in the Russian-Ukraine war, all the sanctions, now they're going to fourth level of sanctions. I think, one, it's going to help our economy when it comes to gas, iron ore, aluminium, things like that. But unfortunately, for the average person, it's going to make expenses harder. So even without the interest rates at the moment going up, it's going to be harder to pay a mortgage anyway over the next 4 months. So with interest rates going up as well, I think that people that are close, and there's a lot of people that had FOMO that just went in, really went nuts. And I was trying to tell people, you can't get too much FOMO when investing in property. You really got to do your research and do it unemotionally. So a lot of people paid way too much for their property, and they went in right. They're so tight, and those people that are tight, they're going to be having a bit of a challenge, which may create a bit of a correction for everyone.
Absolutely. Well, we should watch with interest what's going to happen. I think that things are quite uncertain at the moment. And I've always said, people, be a little cautious, make sure you don't overstretch yourselves and make sure that you don't just jump at the first thing that pops up, because sometimes, unfortunately, the thing that pops up is there for because nobody else wanted to buy it, right?
Exactly. I really stress that, especially in times like this, but you need to really be cautious, do your due diligence, and if you're going to buy something, make sure you get it right, get your numbers right. Don't just jump in.
Absolutely. Well, I enjoyed speaking with you again, as always, on property. If people want to know more about your methodologies, you've got a particular approach that you take. Where do they go?
Okay, so what they can do is they can go to positivepropertysolution.com.au, or we're actually doing an event with Robert Kiyosaki at mastersofwealth.net. That's probably the best way to go. Come and see us there and watch us live talking about this stuff.
Terrific. Well, I appreciate your time today. And Robert's always good value. He's got a very particular view, which is always good to understand, particularly now where he's saying buy Bitcoin as well. There's some quite interesting stuff going on there. So we'll make sure that those links and things are below. And thanks for your time today.
Great. Thank you. Bye-bye.
Bye.
Yes.